You know, every single day, there's a silent system working in the background, making these huge decisions about your financial life. We're talking loans, credit limits, the whole shebang. And the new gatekeeper? It's artificial intelligence. So, how does it actually work? And maybe more importantly, is it fair? Let's get behind the algorithm and find out.
Okay, so it really all starts with a pretty simple question. We think of our phones as, just for calls and texts and social media, but in this new world of algorithmic finance, they're basically data gold mines, and the information inside might be predicting your creditworthiness as we speak.
Think about it. When you download a digital loan app, you're often agreeing to share just a staggering amount of personal data. And I mean everything. We're talking your contacts, your SMS logs, your GPS location, even your photos. This is the raw material, the building blocks, for a whole new way of assessing credit. Now, to really get why this is such a revolution, we have to take a step back and look at the old way of doing things. For decades, the traditional credit score has been the final word on financial reliability. But its view of us has always been, well, pretty narrow. I mean, really think about it. Before the 1950s, getting a loan was all about a loan officer's personal judgment call. Then, boom, 1956, the FICO score comes along and brings in a standardized mathematical system, which was a huge leap forward for sure. But that system was built for a totally different era, and now it's really struggling to make sense of our messy, complex digital lives. So here's the thing. The traditional model has some serious blind spots. It's really focused on just a few key factors like your payment history. And that means it completely misses millions of people who have thin or even non-existent credit files. These are the credit invisibles. Good, reliable people were getting left out just because they didn't fit into this old, rigid box.
And this is where AI steps in. The promise of it all is to move way beyond that limited lens and create a much bigger, more detailed picture of who we are financially. This is that new decision layer, built on all the intelligence that can be gathered from our digital world.
This quote just nails it. Our personal data has become this incredibly valuable resource, like a new kind of oil. And you've got all these fintech companies building these sophisticated drilling rigs, their algorithms, to pull out its value and figure out risk in ways no one's ever done before. So what is this new oil, really? It's something called alternative data. And this is not your typical credit report stuff. It's things like your utility and rent payments, your online shopping habits, even your social media behavior. And get this, some algorithms look at super subtle things, like whether or not you capitalize the names of contacts in your phone. Wild, right?
I mean, the potential here is enormous. By sifting through this ocean of data, AI can theoretically build a way more dynamic and inclusive picture of who's a good credit risk. It could finally open the door for all those credit invisibles who were shut out before. But, and this is a big but, there's a catch.
With any powerful new technology, there's always a potential dark side. And for AI, it's bias. This is the ghost in the machine, that unintentional and often totally invisible prejudice that can get baked right into the code that's making these incredibly important financial decisions. And here's the root of the problem. Algorithms don't just think for themselves. They learn from the data we feed them, and they're built by humans. And that means our own biases, conscious or not, can get written directly into the code, ready to be scaled up and applied to millions of people.
And if you want to see just how real this is, just look at some examples outside of finance. Amazon had to scrap a hiring tool because it taught itself to discriminate against women. Microsoft launched a chatbot named Tay that turned into a racist wreck after just a few hours learning from Twitter. These aren't about loans, but they show you just how fast AI can go off the rails.
So how does this actually happen in finance? Well, one way is something called sampling bias. Let's say the data used to train an algorithm is skewed. Maybe it comes mostly from male smartphone users because they were the early adopters. Well, that model will naturally get better at understanding men, and it could end up being biased against women as a result. Then you have labeling bias. This one's a little sneakier. You might tell the algorithm, hey, don't look at gender. But if you label jobs as doctor versus nurse, the algorithm can pretty quickly figure out that those labels are strong stand-ins or proxies for gender, and it might start making biased decisions anyway. And finally, there's outcome proxy bias. This is when an algorithm basically takes a shortcut. So instead of trying to predict if you as an individual will default, it might just use your zip code as a proxy for risk. And that's obviously not fair, right? Because where you live has nothing to do with your individual character.
This all leads to a massive transparency problem. These AI models can get so complex that they basically become black boxes. As this quote points out, sometimes even the lenders using these tools can't explain why the AI made a certain decision. And if they don't know, how are you supposed to?
But okay, the story doesn't end there. We're not powerless in this. Researchers in a lot of responsible companies are working hard on ways to find and fight this bias, to actually tame the algorithm and make it work for us fairly. So how are they doing it?
Well, there's a pretty structured three-stage approach. First up is pre-processing. That's where you clean up the data before it even gets to the algorithm. Then you have in-processing, where you build fairness rules directly into the model's learning process itself. And finally, there's post-processing, where you can actually adjust the model's final predictions to make sure the outcome is fair.
But look, technical fixes alone aren't going to solve this. Real fairness needs human oversight. It means getting the whole organization involved, not just the data scientists. It means constantly checking up on the algorithm to see how it's doing. And crucially, it means knowing when to hit the pause button, like when a huge event like the pandemic happens and makes all your old data pretty much useless.
So all of this leads us to the final and most critical question. Who's ultimately responsible for making sure these super powerful systems are used ethically? Who gets to write the rules for the machines?
And there's a big debate going on here. On one side, you have people arguing for industry self-regulation. They say technology just moves too fast for governments, and that being fair is just good business anyway. On the other side, you have people who are pretty skeptical, saying that without the force of law, companies won't ever prioritize fairness over profits.
Well, in the United States, the government has made its stance very clear. The Consumer Financial Protection Bureau, the CFPB, has flat out stated that all the existing anti-discrimination laws still apply to AI. No ifs, ands, or buts.
And what that means for you at the end of the day is this. Lenders can't just hide behind a black box algorithm. If you get denied credit, they are legally required to give you a specific and accurate reason why, even if that reason sounds a little weird, like based on your purchasing history. It forces them to be transparent.
So, this is where we're left. These silent systems, these machine decisions, they are the new gatekeepers of financial opportunity. They're the ones deciding who gets a chance. But the question that we all have to keep asking is a human one. Who gets to decide what's fair?